Good afternoon and welcome to the SIA Wealth Management Advisor Update for July 2026. My name is Colin Cieszynski, Portfolio Manager. Unfortunately, Paul Kornfeld, our Director of Technology Services and Portfolio Manager, wasn't able to attend today, but I will be speaking on behalf of both of us. So we'll start off with the equity action call. It's been a bullish quarter for equities. The equity action call actually has been rising through most of this year. Equities have been increasingly outperforming relative to other asset classes. It remains in the green favored zone, and generally speaking, our portfolios have remained 100% invested in equities. Looking at equity markets in the last 3 months, it was positive for North America, a positive month for Europe, a kind of mixed month in other parts of the world. South Korea and Taiwan were extremely strong. China, Saudi Arabia, Brazil, and Indonesia were soft. We see that some of the strength that we had in the early part of the quarter came off later in the quarter. Although Europe remained strong through June, we did see a little bit of easing off in North America. Looking at world markets, what we see is the blue line is international and developed markets have continued to outperform. The green line, emerging markets, started to trail off in the last few weeks. This is not unusual because we can also see that the Canadian market has been lagging. And what we've seen is that resource sensitive markets did come off later in the quarter along with commodity prices. Looking at U.S. indices year to date, the big story here is this has been the small cap market. Small cap, large cap, mega caps have underperformed so far this year, and that has had an impact on portfolios depending on which universe they're exposed to, mega caps versus broader universes. Because in this case, this year, the broader universe has been outperforming the mega caps. In terms of currencies, something that's most notable here, gold peaked back in at the end of January, well before the war started, and has basically been trending down for almost 5 months now. We saw Bitcoin has been falling off in stages as well. Had a sell-off at the end of January, had another sell-off near the end of May, and it's continued to drift downward. The loonie's been drifting downward as well, and the U.S. dollar has been strengthening. In terms of commodities, what's most important here is look at towards the right hand side. The blue line is natural gas, the orange line is crude oil. We've had this big pullback in crude oil since the states started talking about ceasefires. But what's most important is this: when oil was trending down in late June, the price of gasoline stabilized and actually started to trend back up. And what was interesting there was noting that the oil was responding more to the political conversation, and it seems as though the natural gas was responding more to the actual demand dynamics that were out there. And of course, we've seen this week that the U.S. and Iran things weren't quite as rosy as it had seemed. And that the reality is that the road to peace could be quite bumpy, and we're seeing that with things like gasoline remaining elevated. Something else to note, because of the combination of the war and other factors, we've seen inflation pressures starting to build, starting to increase, and we started to see this shift in the way that central banks have been thinking. Through 2024, early 2025, central banks were in easing mode. The later part of 25 and the first part of this year, central banks kind of backed off and went to neutral. Now we're seeing banks start to raise interest rates. We've seen Australia raise rates, New Zealand raise rates, Japan raise rates, Europe raise rates, and if nothing else, the Fed has kind of hinted that there could be a rate hike coming there too at some point down the line. So this is a shift, and it's important in terms of its potential influence on the markets and on sectors. Looking at now, we're going to, speaking of sectors, we're going to rotate and look through how some of the sectors are doing year to date. Well, something we saw with resource sectors had a big rally early in the year and then started to come back off. The orange line is energy. The green line is the gold sector, had also weakened quite significantly over the last number of months. The blue line is the U.S. materials sector. That's more stable and steady, and the reason is because that tends to be less mining and more steels, more chemical type companies, and that has been relatively stable. In terms of defensive sectors, things have kind of been sideways for the utilities, the staples, real estate. What's most interesting about this chart is the healthcare sector, which was the purple line at the bottom, had underperformed for much of this year and has really started to accelerate upward in the last 4 to 6 weeks. Looking at the cyclical sectors, we've had strength throughout the year in industrials. Financials had lagged, but it's another sector that has started to accelerate in recent weeks, and consumers discretionary have kind of been spinning their wheels. Looking at the momentum sectors, something that was really interesting here is the big discrepancy between technology has been the biggest outperforming sector year to date. But it didn't start that way. It started to accelerate end of March, early April. So this quarter was absolutely spectacular for tech stocks, and even communication stocks were not able to keep up. Specifically breaking down technology, what's important here is that it's not everything, it's the AI trade, and seen most clearly in the semiconductor ETF, which had an explosive rally and then has been kind of choppy for the last couple of months, say again 4 to 6 weeks. But down here, software and services absolutely have been lagging throughout this entire year. And I also just wanted to mention financials. And what's the most important part here? This green line is the Canadian banks. The purple line is the US banks. And the blue line is insurance companies. So Canadian banks have been outperforming all the other financials all year. The US banks have started to pick up a little bit, and the insurance companies have been picking up a little bit. And we've seen that as the way we've rotated through our portfolios. Now I wanted to shift over to our portfolios and wanted to start a little bit with our investing philosophy. We use a disciplined, rules-based investing approach that we base on relative strength analysis. Relative strength for us is head-to-head comparisons of stocks, of bonds, of ETFs, of commodities, of asset classes from the top to the bottom. We have the equity action call, our asset class rankings, sector analysis, and individual stock or ETF universe analysis as well. These portfolios are designed to deliver risk-adjusted performance over a full market cycle. Within that, we do take a tactical approach to investment selection and risk management. We have the ability to go 100% full speed ahead with equities when they're favorable, and the ability to go to 100% cash when things are unfavorable. So we do take an approach, but our goal and our mandate is to perform over a full cycle. Over that, and because of that, portfolios may outperform or underperform over shorter time frames. We are focused on the big picture. We're focused on the big moves. We're not focused on the chops. Sometimes the system takes us out, and sometimes the system keeps us in, and it works both ways. And the feedback I get from clients is really important. I've had a lot of feedback that says, Colin, you've changed our lives. Colin, what the system does for our clients is to free up time for your clients, free up time for your business building, free up time for your families, free up time for yourself. And it's a huge improvement in quality of life for advisors and clients. And that's what we help to bring to everyone and to deliver. So now looking at the Q2 performance, I'm going to start with the portfolios where we are a sub-advisor for BMO Global Asset Management. All four portfolios generated positive returns in the second quarter, and throughout the quarter held maximum equity exposure across the board. Returns benefited from rotation into technology, financials, communications, aerospace, and healthcare stocks. Depending on the timing, there was some choppiness and volatility, and some of the sectors that detracted included energy, technology, some technology, steelmakers, and defense stocks. And something that was interesting during this quarter was that it shifted from the start of a war to heading towards peace talks, we saw a shift within a sector of defense stocks started to underperform relative to aerospace stocks, and there is a difference between the two, and it's usually they're in lockstep, but this was one where there was actually a divergence, which we did capture with changes in the portfolio. Where possible, we did find that increasing U.S. exposure relative to Canada benefited returns. And we saw that on some of the slides earlier where Canada was lagging with the pullbacks in commodity prices and resource stocks. In particular, the BMO SIA focused North American equity fund, which is a mega cap US and Canadian portfolio, benefited from renewed relative strength in North American mega cap stocks in the last month of the quarter. June was a very strong month, and when mega caps came back, the portfolio came back big time. So looking at portfolio returns as of June the 30th, I'll just highlight some of the numbers here. I'll focus on year to date, but we can see that there's solid numbers across the board for everything. Our Tactical Global Equity ETF fund is up 22% year to date. It was up 17% in the quarter. The Global Asset Allocation ETF fund, which is a combination of the Tactical Global Equity Fund plus a fixed income component, that delivered 14% so far year to date. The BMO SIA Focused North American Equity ETF Fund is up 8.3% year to date. Yes, it lagged, but it really came back this quarter. It was up 16.2% in the second quarter, the second best performing of the funds. The BMO SIA Focused Canadian Equity Fund continues to deliver strong returns. It's up 23% year to date, was up 11% in the quarter. We'll show this on charts relative to some of the major indices that are out there. In all cases, the orange line is the portfolio, and the black line is a comparable index that help to comprise some of our benchmarks. So in this case, the Tactical Global Equity Fund versus the MSCI World Index has been outperforming throughout the year. The Global Asset Allocation ETF fund, the balanced fund, interestingly enough, has been pretty much in line with the MSCI World Index ETF, even with the fixed income component, and has significantly outperformed the aggregate bond index. The North American Equity Fund did lag in the between about January and about the end of and into April. That was the period where mega cap stocks, in particular, did underperform. But we've seen it come back, and it picked up quite significantly over the last month or so. You can see there was a leap in the early part of May, and another leap in June in terms of catching up. And the Focus Canadian Equity Fund has been outperforming the S&P TSX Composite Index throughout the year. And what's interesting here, if we look at the last month or so, the portfolio continued to climb during a period where the benchmark index leveled off. In terms of rotation and changes within the portfolios, I'll speak to in general. In country rotation, both for stocks and for broad-based ETFs, there was a rotation from Canada to the U.S. And and the international was stable. And in terms of sector rotation, we did see rotation out of materials and energy, more into technology and healthcare, and some of the other more cyclical sectors as well. So in terms of portfolio exposure, as we look at each one, we'll start with the Tactical Global Equity ETF fund. Had a large increase in exposure to the U.S., a decrease in exposure to Canada, and a moderate increase in exposure to international equity. The Tactical Global Asset Allocation ETF fund, similar, but of course, since it's 60% equities and 40% bonds, the moves we had were smaller, but they were all the same directionally. For the BMO SIA Focused North American Equity Fund, we saw a rotation from U.S. equity from Canadian equity. And for the as BMO SIA focused Canadian equity fund, it was stable through the quarter because it's all Canadian. The in terms of exposure to sectors, we've broken the sectors into four major groups. The resource sectors is energy and materials. The defensive sectors is utilities, staples, real estate, and healthcare. The cyclicals are financials, industrials, and consumer discretionary. And the fourth one, momentum, is technology and communications. The high growth, high alpha, high beta kind of sectors. So for the and so what we see here's some of the bigger trends in the tactical global equity fund, a significant drop in the allocation to resources and a significant increase in the momentum sectors, resource to technology. The same thing in the global asset allocation fund, again, same directionally, just smaller. In terms of the North American Equity ETF Fund, a huge decrease in resources from 24% to zero. And we saw there that it was the shift was more into cyclicals and also some into defensive sectors as well. And in terms of the Focus Canadian Equity Fund, a smaller decrease in resources, and that was a rotation more into cyclicals. So we'll now take a look at the performance and changes in the SIA MO Global Tactical Pool. During the quarter, we had a significant corporate action and a special distribution that led to raising cash at some points and then investing back into equities at other points during the quarter. Overall, however, the pool did continue to generate positive returns over the course of the over the quarter, continuing its momentum of the last number of quarters. Currently, the pool operates a sleeve-based strategy, and in June it completed 2 years of successful operations. The sleeves are the ML Mega Cap 5, the USA 5, which is a more large cap sector-based approach, the Canadian 3, and the International 3. Returns during the quarter benefited from rotation into the technology sector, particularly AI-sensitive stocks, and also into industrials. Once again, depending on the timing, some technology and communication holdings detracted from performance while others helped. Other detractors included energy producers, miners, and steel makers. The portfolio benefited from its exposure to the broader universe of large cap stocks as the mega caps underperformed through much of the quarter, although they did come back in June. In terms of returns for the pool, the year-to-date return is 21.2%. It was 14.4% during the quarter. The one-year return is 54%, and the two-year return annualized is 31.67%. Looking at the portfolio relative to the MSCI World Index ETF, we can see that the pool has been outperforming the major trend in global equities throughout this year. In terms of recent changes to the portfolio, we did reduce cash and rebalance the portfolio around the corporate action and special distribution. In terms of sector rotation, we reduced exposure to energy, materials, communications, and industrials, while increasing exposure to healthcare, consumer discretionary, and technology. In terms of country exposure, it's fairly stable for the most part. A small increase in U.S. equity, a small increase in Canadian equity, small decreases to international equity and to cash. And in terms of sectors, a significant drop, as I noted, we did rotate out in a meaningful way away from resources, and that was reallocated primarily into defensives and momentum sectors, and a little bit into cyclicals as well. Looking ahead, relative strength analysis has increasingly positioned the fund for a post-war environment. We've had increased exposure to technology and healthcare, decreased exposure to energy, materials, and defense sectors. The commodity prices, particularly oil, have retreated back to pre-war levels. Other commodities, however, I showed gasoline, but also copper, have declined at a slower pace. Future trends in the commodity prices depends on what happens with UN-Iran negotiations and the reopening of the Strait of Hormuz. We've even seen that in the last few days that this road could be bumpier than people were thinking. The North American economy has been remarkably resilient throughout the war, but at some point, the full impact of higher prices and rising interest rates may be fully revealed. It's an ongoing uncertainty. There's been a debate going on between growth versus valuation, particularly in AI stocks, and there's been a lot of volatility even in the last week or so. And this may continue through the summer as we move through earnings season and people focus in on guidance again. Leadership could change if focus shifts towards reconstruction. We'll see. There's always one of the most exciting things about the markets, and is that it's always changing. There's always things happening, and we're ready for it though. Relative strength analysis helps to continue to separate the larger shifts in sentiment and capital moves from the short-term noise. As I said, sometimes the system takes us out of things, sometimes it keeps us in, and that's why relative strength analysis is so powerful and so important. So we continue to monitor every day for changes in investment sentiment. We are ready to make tactical changes as necessary based on the capital flows between asset classes, sectors, and individual securities. And at this point in time, we'll conclude our update for this month. And we'd like to thank you all for joining us today and look forward to speaking with you again soon.